It's magic that way.
Yeah.
And then we're just like, it's been in Tulsa.
My personality.
The Employees Retirement System of Tulsa County, Tuesday, April 27th at 10:33, please. Do I have a motion to approve the minutes of the March 30, 2021 regular meeting?
Second.
Baker,
Yes.
Fothergill,
Yes.
Little,
Yes.
Lord,
Yes.
Salee,
Yes.
Willis,
Yes.
Hurd,
Yes.
Kaiser.
Yes. Do we have any unfinished business?
Not that I'm aware of.
Okay. Treasurer's report ending March 31st, 2021 by Rachel Johnson, please.
Okay, so the usual, the transfer to the DDA to cover payables last month was 2.1 million. The snapshot for the month of March, a net investment income of 4.3 million. That means fiscal year to date of 56.7 million, and total value is right at 334.5. And then there is a judgments update this month. I think you guys all received the spreadsheet that shows that the judgment for Ebony Wilson was purchased on April 14th, and that brings total judgments at $2,491,716.70. I'm happy to take any questions.
Thank you, Rachel. Thank you. Do I have a motion to accept and file the treasurer's report?
Move to accept and file the treasurer and judge report.
Second.
Baker,
Yes.
Fothergill,
Yes.
Little,
Yes.
Lord,
Yes.
Salee,
Yes.
Willis,
Yes.
Hurd,
Yes.
Kaiser.
Yes. Do I have a motion to accept and file the investment managers for Barlow Hanley, Winnie, Chickasaw Capital, or PGIM, Siegel Bryant? 1-6.
So moved. Second.
Baker,
Yes.
Fothergill,
Yes.
Little,
Yes.
Lord,
Yes.
Salee,
Yes.
Willis,
Yes.
Hurd,
Yeah.
Kaiser.
Yes. The preliminary investment performance review, Doug, March 31st.
Good morning, everyone. I think we have the technical challenges addressed here. Thumbs up, silent. So I'll be able to present it on screen today. This is the preliminary report. As of March 31, full report will be happening at the next monthly meeting. So this is calendar year to date, 1/1 of this year to 3/31. And just to call brief attention, look at the upper right-hand side, see the returns of the major indexes. Look closely there. The one that's the highest and has the highest return over that 3-month period of time is the Russell 2000. Those are small cap stocks. They're up 12.7%. The other two are IFA, or International Equities, sorry, ACWI, and Russell 1000, which are 1,000 large cap stocks, both up. The Russell 1000 at 5.9%, MSCI IFA, that's all countries in the world, up 3.49%. What you'll see, unfortunately, on the downside there, you'll see the dotted lines are fixed income. You'll see that those are negative on a year-to-date basis because interest rates have risen. Looking on the market environment here, this is for the month, interesting to look at. In many senses, what was the worst performer last year was the best performer this year. And if you look across the top there, Russell 1000, Russell 2000, ACWI ex-US on the middle part of the chart, the largest table down there. We'll see the green columns out to the right, and that's energy. Barrel of WTI is now selling for $62.50 right now, which if you think back to last year, about this time, it was negative $40 a barrel. So we've seen a $100 swing in the price of oil over a 1 year period of time. And like we're hearing about other places in the market, supply chains are disrupted, and there are potential large increases in the amount of commodity prices, and there's potentially an inflation build looking at the economy. One of the things that you're hearing anecdotally is lumber. Of course, lumber prices are through the roof right now. And another thing, small businesses are having a really difficult time hiring workers to come in because it pays more for a lot of folks just to stay home. And that will be the case until September, likely, because that's when some of those laws, the emergency laws, were put into place to stabilize the economy. But all in all, if you look at the year-to-date returns, we're positive on equities, we're more positive on smaller companies than larger companies, and value companies are performing well. If you could turn to the next slide, please. These are the figures. You'll see for the 1 month just ended, we started on the upper left-hand side there, see the market value as of 3/1 of 2021, $329 million, contributions of about 1.3, distributions of about 2.1. And you'll see appreciation was $3.8 million, and that was all from equities. In fact, our fixed income exposure for the core or the intermediate core and the Hoisington active duration portfolio were all negative. One of our high yield funds is negative. It's something that I'm frankly looking into because it's so surprising to me is that the real estate funds are both posting first quarter gains. Now, we don't have those figures yet because they haven't been fully reconciled and audited, but last year, if you remember, we were thinking that it was a very difficult real estate market. But we're seeing gains on those real estate allocations already. The next slide is going to be the calendar year to date. And so these are all big numbers, but we started the year with $322 million. Contributions are positive at almost 4, distributions at 6.1 or 6.4 negative. And then appreciation of 10.6. So far, year to date, it's been a fantastic year. And I even dragged the numbers forward to last night. So as of 3/31, the figures were $332 million, which is an all-time high. As of last night, it closed at 338. So the gains continue to be incredibly strong. And at this point, I must say that we cannot project these returns going forward. Cannot do that. It's been great. It's been fortunate that we have done this. But the equity markets were responding to an unprecedentedly fast sell-off last year, and then unprecedentedly large government support mechanisms that were put into place. Now, the next slide, here are the figures. As of 3/31, and the full report will be available at our next meeting. You can see for the month, the total fund was at 1.31%. For the quarter, it was at 3.94%, which in actuarial terms is pretty strong for 3 months. Year to date is the same figure. Fiscal year to date, as we're going into 1 quarter left, we're up 20.5%. Our actuarial assumption over that period of time is 5.39%. And our policy index is 16.18. So we're outperforming the market weighted benchmark, which is asset allocation, But more importantly, we're outperforming the actuarial assumption. And if we look back over the last year, 35.45% outperforming both of those benchmarks by significant margins. And then even over the last 3 years, if you think about it, we had that massive drawdown in the first quarter of last year, but our 3-year return is still above the actuarial assumption, trailing the policy index slightly. Now, looking down, I'm going to focus on the 1-year rate of return. For the S&P 500, it was up 56%, which is amazing. All last year, you probably were sick of me saying the cap weighted indexes are outperforming by bigger and bigger margins. But then you look at what happened to our SMID cap equity portfolio. This is value oriented, concentrated portfolio. You don't see returns like this very often. I mean, the last time I remember seeing returns this high was either immediately after the financial crisis or just before the internet bubble burst. That's a long stretch of time between these three. But 118.92%. Fortunately, it did outperform its benchmark. Both of those were up. You can see 73% for the mid-cap indexes, and then the Russell 2000 index was up 94%. So just astonishingly strong returns here. Our international equity portfolio was at 54.43, outperforming its benchmark. The MLP portfolio was up 95% last year. We are not at our 5% target there, but I think that it's been an incredible run. The first quarter of this year was the strongest 1-quarter return for any sector in the S&P 500 since the Great Depression. It was up 40%. Because energy has been so disliked for so long that once it does spring back, it does come back nicely. Now, disappointing news is our bond portfolio returns are low. And we keep bonds around because they stabilize the portfolio when everything else is not doing well. This is not a time to exit bonds, even though they are a negative cost of carry, if you will, versus our actuarial assumption, but they do stabilize. I do want to remind everyone that we increased our equity allocation. So we have more equities than we used to. So that's minimizing or lessening the drag that we're going to see. And really, the one most shocking return here has to be Hoisington, the active duration bond portfolio. So the 30-year Treasury is now officially in a bear market. It is the one asset that is in a bear market. But if you go back to a year ago, equity market down 30, S&P down 30%. This portfolio was up 30%. That's why we keep it. Now, on the next page, our high yield bond portfolios. You can see them here. Remember, this is sort of a hybrid between equities and bonds. These are below investment grade bonds. And over the last year, returns to almost 28% versus the benchmark at 23. So excellent results there. Again, our 2 real estate allocations, $14.1 million. As of last night, they updated the value of PRESA to $7.2 million. So continuing to increase slowly over time. And remember, this is taking the part of some of our fixed income allocation, relatively stable assets. If you could go one last slide, just to remind everyone, I know the figures are a little bit small here, but if you look down at the bottom left-hand side where you see January 2021, this shows the new asset allocation index, which is effectively what our target asset allocation is by asset class. So we've got 17.5% in the S&P 500 index fund. Below that, we have the Bloomberg Barclays US aggregate at 1875. As you go down that list, I read that wrong. That's the combined allocation there. If you look down the list for the high yield master, 7.5, the Russell mid cap at 25, Alarian MLP at 5%, and then IFA at 12.5, and our other our real estate at 5%. So with that, I hope before I retire to be able to bring a quarter this strong to you again, but I'm really not counting on it, or a year this strong. For a balanced portfolio with stocks and bonds to put up a return of 35.5% is remarkable. It is as good as the loss during the first quarter of last year was. But the other side of that coin is that sometimes you have to have dramatic disappointments to have dramatic victories on the other side. So the full report will be next month. Happy to take any questions.
So Doug, we're in April
Yes.
and we've not addressed any more the actuary recommendation to lower the actual rate of return. What do you see? Does that need to be, do you think that needs to be addressed before fiscal year end or what?
Why not? This only has going back 3 years for the total fund. I think after the last year that we've had, we're probably in excess of the actual assumption overall periods. After this past year, it's an ongoing dispute I have with actuaries saying you always have to move lower. And remember last year, they were saying in the middle of summer, we have to move lower because this return is not going to be achievable in any time in the near future. And we're probably just the best 1 year return ever for this fund. I am totally comfortable with 7.25. And I believe that with the new allocation that we have, it may not look, using the long-term assumptions, it may not say 7.25. But I would like to have another talk. What was the latest recommendation? Please remind me. Was it to 7 or 6.75?
6 3/4, I believe.
That's going to increase your cost significantly.
Right.
Well, what we've talked about before, in all likelihood, if the market environment is such that we're not going to meet 7.25, we probably won't hit 6.75 either. You're either going to overshoot it or you're going to come under, just depending on what the market environment is. So I don't know if it's going to make much of a difference
That's true. I think
year by year.
if you look back over history and you roll annual, 4 or 12-month periods, you roll them over and over and over again. And exactly what you said, it's observable that I think I've done this for another client. I'm happy to do it here also. But you look back over a 20-year period and you roll it quarter, so you have much more than 20 observations. And you look at the number of returns that fall between that 7.25 and 6.75. And out of all those observations, you might have one more 12-month period that meets the rate of return. So let me gather some more data. Let me put together that schedule and see what that looks like. But I don't hear a lot of other actuaries right now pushing for it very hard. They're sort of backed off a little bit. But I think it's worthy of a conversation.
At least one more before end of fiscal year.
Yeah, we just did 5 years worth of that return this year. So rough numbers, back of the envelope.
I've got some questions. So our 35% 1 year return, how does that compare generally to some of your other public sector clients?
Not that high. I was at a client yesterday that was a foundation. They did 34.5%. It's right. It's mid-30s, which is pretty amazing. I saw some other interesting data recently, and I'm not trying to tie this back around to the ESG question or anything like that we had last month, but it was comparing endowments and foundations, which are kind of like us. They have long-term rate of return. They have a number that they need to take out each and every year. And it's sort of a different style of investing. They tend to invest more in alternatives, so hedge funds and private equity, the kind of things that we've been a little bit more deliberate about investing in, because it's either going to, in my mind, this portfolio is either going to pay income or produce returns above what we need, right? That's how I segment it out. So I look at a hedge fund and say it really doesn't do either of those things. But for whatever reason, those are very popular amongst this foundation endowment crowd. There's 400 of these funds throughout the country. And they looked back over the last 10 years. And oddly enough, the foundations and endowments below $100 million, right, the smaller ones of this group, and that was only 20% of the assets within the population. So the ones below $100 million, they outperformed the large ones over that period of time, right? They have less resources. They look more like us than having, 30% of hedge funds or whatever. So not only that, but the lower your alternatives allocation, the better your return was. So the small funds that had lower allocation to alts did better. And then the larger funds that had lower allocation to alternatives did better than the other large ones. So I think that's a good reminder that what is being sold to institutional investors is not what is always right for institutional investors. We have a very, I guess, Melissa, I don't know how you would characterize it, a fairly traditional portfolio here, although we have more equity than most. We have more small and mid cap than most, but we're not investing in a lot of hyper exotic. I mean, most exotic things we have right now, I think, are either pipelines or real estate. Right? That's not very exotic, but it works. And that was another thing that I saw yesterday that I thought was very interesting. Also, our fees on this portfolio are relatively low. These alternative investments are 2% management fee and then 20% of your profits. That might have something to do with the lower performance. That's a very, very long response, but I'm comfortable where the portfolio is. We do need to continue to move to our new asset allocation. We're not there yet, but we need to continue to do that, which means the next time that Rachel takes a draw off the portfolio, it's going to come from bonds. And that should be coming fairly soon. And then as of June 30, that's when I will sit down, Rachel and I will sit down together. And if we're not there yet, we'll have a plan to get there pretty quick.
Thank you.
Thank you.
Any other questions for Doug? Thank you, Doug. Motion to accept and file.
Move to accept and file.
Baker,
Yes.
Fothergill,
Yes.
Little,
Yes.
Lord,
Yes.
Salee,
Yes.
Willis,
Yes.
Hurt,
Yeah.
Kaiser.
Yes. Are there any additional items not known before the agenda was posted? Okay. Committee reports.
I don't have any reports. I do just want to bring the board, make the board aware. Kenner, Michael's legal counsel has been investigating some of the outstanding things that we've sent to the DA that they haven't had time to address. So I know he wants to start working on the policy and procedure manual. There's a couple of things that need to be updated. So we're going to start having benefit committee meetings soon. And I'll go back and look and see who all's on that committee, but just kind of look for those coming in the future.
Okay, thank you. I have no chairman report. Discussion and action, refunds to be paid by May the 5th, 2021. I'd like to take those 1 through 9, please.
Approval.
Second.
Baker,
Yes.
Fothergill,
Yes.
Little,
Yes.
Lord,
Yes.
Salee,
Yes.
Willis,
Yes.
Hurt, Kaiser.
Yes. Payment of the following invoices. I'd like to take those 1 through 7, please.
Patient.
You have an amended agenda.
Oh, I apologize. I guess I didn't. Sorry, 1 through 8.
So moved.
Second.
Baker,
Yes.
Fothergill,
Yes.
Little,
Yes.
Lord,
Yes.
Salee,
Yes.
Willis,
Yes.
Hurt,
Yes.
Kaiser.
Yes. Sorry about that. Approval of retirement pay applications effective May the 1st of 2021, 1 through 6, please.
Second.
Baker,
Yes.
Fothergill,
Yes.
Little,
Yes.
Lord,
Yes.
Salee,
Yes.
Willis,
Yes.
Hurt,
Yeah.
Kaiser.
Yes. Approval of surviving spouse retirement application for Patricia Gilmore.
Approval.
Second.
Baker,
Yes.
Fothergill,
Yes.
Little,
Yes.
Lord,
Yes.
Salee,
Yes.
Willis,
Yes.
Hurt,
Yes.
Kaiser.
Yes. Approval of cancellation of the following benefits, 1 through 7, please.
Sorry.
Baker,
Yes.
Fothergill,
Yes.
Little,
Yes.
Lord,
Yes.
Salee,
Yes.
Willis,
Yes.
Hurt,
Yes.
Kaiser.
Yes. Approval of suspension of benefits effective April the 30th for Randy Sutherland, who is returning to work full-time.
Move to approve the suspension.
Second.
Who was that? Baker,
Yes.
Fothergill,
Yes.
Little,
Yes.
Lord,
Yes.
Salee,
Yes.
Willis,
Yes.
Hurt,
Yes.
Kaiser.
Yes. Any new business?
Well, Doug's not here, so I guess not.
Okay.
Move to adjourn.
Second.
All those in
Aye.
favor? Aye. Thank you.
You're fine. Thanks, everyone.